managing partner of the Rito Gold and Associates. We are a practicing firm of auditors and accountants in Nakuru. And apart from that, we are consultants on various issues on taxation, accounting, and consulting on advisory on some of the tax issues that affect clients. Income tax return. There are so many returns that we need to do here. First of all, I'll start with the basic ones, that if you are doing business in Kenya, the tax laws require you to file. The first thing is, if you have employees and you are paying them salaries over 24,000, you need to make monthly returns of what you call pay as you earn. Pay as you earn is amount you get from the salary, you subject that to the graduating scale, and then that tax is submitted on or before 9th of the following month after deduction. We have got what we call VAT returns. These VAT returns, or value-added tax returns, are supposed to be done on or before 20th of the following month. And therefore, these VAT returns, you have only to file if your capital is above 5 million shillings. And if you don't file these VAT returns, there is a penalty of 10,000 shillings per month. And if you had a payment you needed to pay and you did not pay, they can charge you 2% depending on the amount, or 5% depending on the amount that you do. But normally they charge 2% per month compounded interest. If you don't file this pay as you earn return, there's also a fine of around 10,000 shillings. Then, we were talking on people who deal with the investments. Someone who will opt to do the monthly rental income, let's say he needs to do that. This attracts only a penalty of 2,000 per month. But again, you have to pay the 10% on or before the 20th of that month, of the following month. Then we come to other returns that we look at here, are maybe income tax returns. Income tax returns are done annually. So if a company has the year between January and December, it will mean that you'll file those returns before June of the next year. Meaning that if a company was having its operation between January 2020 to December 2021, definitely by June 2021, if you are operating in January 2020, you should file your income tax returns. If you don't file for one reason or the other, and you are a corporate or a company, these ones attract a penalty of 20,000. If it's an individual return, because you may be a person, you also attract a penalty of 2,000 shillings per return. That means you are supposed to even if you don't do business and you have a PIN with KRA, it means you should file a zero-rated return. And that zero-rated return can also be done for VAT, and it can be done for the annual returns, whereby you say you didn't have any income, but you don't leave your PIN blank. You use the iTax system, whereby you go and file a new return. So that new return will just say that you avoid these penalties that will be done by the system in case you fail to make that return. Then, there are some other taxes, like the withholding tax, whereby you find that you are doing business with some supplier, and that supplier is supposed maybe to withhold some tax on your behalf. So what you'll find is that tax will be populated in your return. When you come to file for it, it will offset your taxes. There's also what we call advance tax returns. Advance tax returns, those ones are paid for motor vehicles. The motor vehicles, either commercial or matatus. So if you have a pickup and you have a business lorry, you need to pay that advance tax depending on the tonnage of the vehicle. Then we also have to do returns on maybe when you are doing like imports, you have to have excise duty returns. Those ones you have to do at the customs. And then we have people who produce beverages and water. There is a tax that you pay. It's called excise duty also. And that excise duty will depend on the quantity you have produced. So you find all these taxes have got their time and duration. Like this excise duty is supposed to be filed on or before 20th of the following month. Meaning if you did your business between January 1st to 31st January this year, by February 20th, that return must be filed. If you don't file, there's that penalty, so 20,000. So you find that the consequences of not filing any taxes will attract some penalties and interest. And then there is a principal tax, whereby you are taking the tax of the government and loading it to yourself. So what we call opportunity cost. If you paid on time, you don't have to incur that cost. But in case now you say you will not pay and won't pay, they will take very stringent measures, whereby Kenya Revenue Authority has a power to freeze your account and order your bank manager to be an agent of KRA and collect all outstanding taxes on behalf of the department. And therefore, those people who chest lump that they can't pay and won't pay taxes, they have got their now time, that they are just given an assessment which is estimated and it could be higher than the taxes they would have paid, and it means within a short time you find that you can't access your bank account, you can't even be employed, and sometimes you can be blacklisted, depending on how serious it is. And therefore what we encourage is compliance. Compliance is easy. When you get a qualified accountant and your auditors will advise on what we call tax planning. Tax is very easy because everything falls in its own position at the correct time and the correct date. And that's what we call canons of taxation. The tax should be very easy to collect. The tax should not be something you don't understand. And therefore, as a tax agent, you find that that tax cannot be arbitrary. It has to be predictable. How much are you going to pay? And then you also look at the tax returns. They give you a window period. Suppose you are sick and you are not in Kenya, or you are imprisoned, or something unusual happens to you and you are not able to file these returns. The government is not very unreasonable. It says you inform the commissioner with supporting evidence. Maybe you are out of the country and you are not able to return, maybe due to these travel restrictions. What you need to do is you bring your passport copy where you are and indicate that I could not do my returns by 20th of the following month because I am the managing director and I was not within the country. We attach that one and you make an application, that penalty will be waived, it will be removed. If you are sick, admitted in a hospital, you only need to produce the medical documents to prove that you did not refuse to comply. What happened, you had circumstances that could not allow you to do it. And then they waive that kind of penalties and taxes. But what we encourage, issues of taxes and returns are not for the business people. Because we know they are not qualified to be accountants. Even this thing I'm saying, some of them don't understand. Only someone will understand is someone who has been trained to know that this is the way the tax regime is working. And therefore, what we encourage is you trust your auditor and your accountants to do the right job, and you focus on them to advise you on the tax issues. So at the end of the day, all these things I'm talking about, the tax agents were able to compute and give you the correct taxes that you are supposed to pay. So tax should not be a big burden when you have a good tax planner and a good tax consultant. And therefore, what we encourage is that where you find your perennial penalties and interest, then there is a perpetual problem whereby it means even you as a business person, you have an attitude that you do not want to appreciate that paying taxes is an obligation for the government. And sometimes you feel that even this thing of taxes is not your right or an obligation. And therefore, to end this issue on tax returns, we find that even when you are doing your estate development, you are supposed to maintain all the documents to support all the expenses you incur and to support all the documents you have used to purchase your land or property. And then these taxes will be computed from the record that you have kept. So what we find is that people don't keep proper records, and when you come to verify your accounts, you find you are paying excess taxes than you are supposed to pay. So what we encourage is that even when you are buying the land, there's another tax I forgot that's very, very important for people who are dealing with land. It's called the capital gains tax, CGT. Capital gains tax is a tax you pay when you buy land and you paid 5% of the residue value. Let's say you bought the land at 500,000, you spent about 450,000, you will pay 5% of the 5,000 as residue value. How will you do that? You ensure that you have got all the documents that you used to support the expenses for that land, and then when you come to sell it to another buyer, before they transfer it to him or her, you file now that return that is called capital gains tax. I think that was very relevant to the topic we had for today on properties and, and leases, whereby if you transfer that property to a new person, that capital gains tax is compulsory. There are some people who even ask, if I don't pay, what will happen? What happens is that at one time, KRA is networking with the other government departments, like the lands office and the banks. You'll find that for you to get that title transferred to you will be a difficult thing. And even if it stays 10 years, you find that they compute that capital gains tax depending on the price that you did at the time you paid your taxes on the land. There's some when you get your transfers done, there's some money that you pay for your title. So before you, even if you pay and that part is done, you have to ensure the person selling you the land complies with that capital gains tax, and that is very much in line with land and properties. Yeah.